Welcome to my channel, Why Trend Money. Are you ready to dive deep into the world of legendary investor Warren Buffett and explore some of his most notable investment blunders? In this eye-opening YouTube video, we're going to dissect Warren Buffett's surprising missteps in companies like Amazon, US Air, and many others. Buffett's investment acumen is renowned worldwide, but even the Oracle of Omaha has had his fair share of setbacks. Join us as we unravel the fascinating stories behind these investments gone awry, uncovering valuable lessons for both novice and seasoned investors alike. From missed opportunities to misguided bets, we'll examine the crucial decisions that led to Warren Buffett's unexpected losses in these iconic companies. Don't miss out on this enlightening exploration of one of the greatest investors of our time and the lessons we can learn from his missteps. Tune in now. His strategy seems simple on the surface, but just like Isaac Newton said, for every action, there is an equal and opposite reaction. And for the investing maestro, this law seems to apply as he experienced his fair share of losses. And today, we're here to explore life lessons Warren Buffett learned from his mistakes that eventually made him mega rich. At number 1, we have Berkshire Hathaway. Believe it or not, Warren Buffett's flagship empire was built on a blunder. In the 1960s, a young and hungry Buffett set his sights on Berkshire Hathaway, a struggling New England textile company. He started buying shares, hoping to quickly profit on an inevitable rebound. But the usually cool-headed investor saw red when Berkshire's managers tried to pull a fast one and shortchange Buffett on a deal. In a rare moment of anger, Buffett went on a buying rampage, aggressively acquiring more Berkshire stock to seize control and fire the offending manager. This power move was fueled by spite rather than the Oracle's trademark calculated logic. And Buffett soon realized he'd made a colossal $200 billion mistake. Turns out the textile biz was no golden goose for long-term returns. As Buffett put it, letting emotions hijack his decisions cost him big time because he was fixated on revenge and didn't realize the textile industry was ending in flames. Buffett learned the hard way. You have to zoom out and read the macro trends, not just the micro company details. Sure, Berkshire Hathaway was his baby, but it succeeded despite his first bad call, not because of it. Buffett's purchase of Berkshire Hathaway showed him he needed to do his homework on more than just a company's financials and thoroughly understand the market conditions and industry tailwinds before investing. Don't forget, the difference between a billion-dollar blunder and a brilliant investment is simply reading the room. And Buffett's number 2 mistake shows how even the best investors can slip up sometimes. And Buffett learned this lesson the hard way in the late 1980s when he broke his own rules to invest in US Air. Despite his general wariness of airlines and their razor-thin profit margins, Buffett got tempted by US Air's juicy preferred stock offering a double-digit dividend yield. The Oracle of Omaha ponied a hefty $358 million to get his hands on those sweet dividend payouts. But principles exist for a reason, and after just a few years, the turbulence of the airline industry shook up the US Air and grounded Buffett's dividends. Though he eventually profited by selling his stake a decade later, it was a rocky ride that tested Warren's patience. Looking back, Buffett admitted this was a multi-million-dollar mistake that stressed him out more than it was worth. It showed him the importance of sticking to the fundamentals of investment. After losing a chunk of change on US Air, Buffett wised up. Buffett realized he needed to fully understand a company's economics and stay far away from those he didn't. As Warren says, rule number 1 is never losing money. Rule number 2 is never forget rule number 1. At number 3, we've got Warren Buffett blowing over $400 million on Dexter Shoe back in 1993. On paper, Dexter looked like a slam dunk. The shoe biz was booming, and Dexter was racking up profits left and right. Smelling a sure thing, Buffett opened Berkshire's wallet and splurged $433 million of Berkshire stock to acquire Dexter. But Buffett didn't look closely at the competition lurking over the horizon. Within a few years, cheap overseas factories ate Dexter's lunch. Dexter's shoes flopped hard as customers flocked to cheaper options, and Buffett's pricey acquisition was soon worthless. And that $433 million mistake was just the beginning. Since Buffett had paid in Berkshire stock, he left boatloads of money on the table as Berkshire's share price skyrocketed. As of 2017, the shares were valued at $5.17 billion. This was a sobering lesson for Buffett on never pulling money from solid investments to take a chance on a wild card. However, that wasn't the only mistake Buffett made, as he overestimated how nimble and savvy the leadership was, and this led to the loss of his multi-million-dollar investment within a few months. But, as Buffett says, you can have the greatest company in the world, but inept or dishonest management can derail everything. When sizing up investments, assess the management team as closely as the financials. Dexter taught Buffett that leadership incompetence can undermine even strong companies. So, choose your investments wisely, because bad management is one competitive threat no moat can protect against. And this next Buffett mistake gave him a gut check after he took over $2 billion of debt from Energy Future Holdings without running it by his right-hand man, Charlie Munger. Buffett should have listened to his advice and had Charlie double-check his math. As he predicted, Energy Future bellied up and filed for bankruptcy. Berkshire managed to unload its holdings, but not before suffering a gut-wrenching $873 million pre-tax loss. Buffett wrote in his shareholder letter that going solo on that one was a blunder. Having his reliable friend Charlie review the details could have saved Berkshire a ton of money and headaches. This trade undoubtedly showed Buffett why two heads are better than one. Another life lesson Warren Buffett learned was how to flee in the presence of red flags. Back in the 2000s, Warren Buffett got schooled on overconfidence when he bet big on Tesco. The British grocery giant looked solid at first, so even as cracks started showing, Buffett doubled down, believing Tesco would turn itself around. But confirmation bias clouded Warren's thinking. He focused on data aligned with his bullish view and ignored troubling signs like the shrinking market share of Tesco. Even when an accounting scandal erupted, Buffett insisted all was well, right until he sold at a massive loss. Buffett let his initial rosy view of Tesco blind him as the company cratered. In this trade, Buffett blocked his constant skepticism and willingness to be wrong. The next lesson life taught Warren is the penalty you pay if you get too caught up in a hot deal and overpay. And Warren learned this in 2015 when he teamed up with 3G Capital to merge Kraft and Heinz. All logic suggested that two consumer food giants joining forces would be great, but Buffett admits he got carried away and shelled out too much, especially for Kraft. The merger left a bad taste when sales stalled and billions in write-downs piled up. Berkshire took a big loss on what seemed like a sure-thing deal. The Kraft-Heinz debacle hammered home that no matter how strong a company looks, overpaying is overpaying, and Buffett overpaid big time. It's a reminder that price always matters in investing, even when you love the company. calculate a company's intrinsic value and stick to what makes sense rather than get caught up in deal fever. In the words of Warren himself, price is what you pay. Value is what you get. Don't sacrifice value for the thrill of the deal. Buffett learned this lesson the billion-dollar way through Kraft and Heinz. Another life lesson Buffett learned recently came with the Amazon stock. After Buffett's $358 million investment in U.S. Air resulted in a loss, Buffett never invested in a business he didn't understand, and this had its repercussions as he missed out on what could have been one of his greatest investments ever. Back in 2017, when Buffett was asked why he never bought Amazon stock, Buffett owned up to whiffing it big time. He said, "Obviously, I should have bought it long ago, but I didn't understand the model's power as I went along." Buffett didn't understand how disruptive Amazon's e-commerce model would become. And while he respected the company early on, he couldn't get over his last experience investing in an unknown market. This was the right move for Warren Buffett then, but now he has realized how it would have been better off if he had educated himself or got insights from others more familiar with next-gen tech companies, because steering clear of new things you don't grasp can just leave you stuck in the past. In the end, humility and curiosity are key. Partnering with someone with complementary strengths would help avoid blind spots. As Buffett said, you only have to be right on a couple of big things in your lifetime to make a real difference. The big thing he got wrong? Amazon. And that wraps up this video on what life taught Warren Buffett that made him mega rich. I hope you found it helpful and educational. As Buffett says, it's good to learn from your mistakes, but it's better to learn from others' mistakes. If you enjoyed this video, please like and subscribe to my channel. I appreciate your support. It helps me create more content like this. Also, let me know in the comments below what investing topics you'd like me to cover in future videos. I love hearing your feedback and suggestions. Kindly hit the notification bell so you never miss new videos and updates. Thank you, and peace out.